Hello, can you hear me now? Apologies. I thought that people could hear me. I was just saying that we're waiting for a minute for more people to join. We're close to 100 now. Um, and yeah, I was just wondering whether, okay, I see people can text. I see someone saying yes. Yeah, I'm going to be starting in a minute. Feel free if you want to introduce yourselves and explain a few words about what brings you here. This webinar is going to be about an hour. I hope we're going to have about 5-10 minutes at the end for questions. But what I would advise you to do is to just type in any questions which you might have in the chat while the presentation is going, and we can address them either as we go along or towards the end. That's great to hear. There's going to be quite a lot of insights in this presentation. It's quite extensive, actually. So I hope, yeah, thank you for being here. So I believe everyone will find something useful in this presentation. But you know, there's a lot of info. So if you feel something resonates more closely with you, just you know, feel free to type in a question. So let's get started. First of all, thanks everyone for being here. My full name is Stylianos Kampakis. You can call me Stelios. I'm a London-based data scientist and AI expert and tokenomics expert. I've been in the space of AI and data science for more than 10 years, and I've been in tokenomics since 2017. So I was actually one of the very first people in the space of tokenomics. I was one of the very first researchers, and that's how I found myself in tokenomics, really. I was essentially trying to figure out how we can use tools from statistical modeling and AI and similar disciplines to study token economies and make them more robust. And that was the early days, 2017. One way brought another, and I found myself doing a lot of work in this area, both as a consultant, a tokenomics auditor and designer at Hacken, as well as a researcher. I'm also a published author, have published 3 books on data science for decision makers. If you Google my name and tokenomics, you're going to find a lot of stuff, including free stuff like papers and studies and best practices and things like that. And in this presentation, we're going to be going through some of that. So the goal of this presentation and this webinar is to walk you through some of the most important aspects of tokenomics. I wouldn't say that's an exhaustive list because we could also add simulations, auditing, game theory, but I'd say these are some points that every project in this space definitely needs to cover, 100%, no question about it. And these are also very good starting points. Also, throughout this presentation, you're going to see that some of the, let's say, points raised are talk about the history of the space, right? Because tokenomics is fairly new, which means that a lot of the things that we're studying, they evolve, like they evolve right in front of our eyes. So token generation mechanisms, fundraising mechanisms, this and that. It's a space that is moving very fast, and this is what makes it often difficult to understand what's the best starting point, right? And there are also many interconnected parts. So it's there are interconnected parts in terms of whether it's launching a new token, game theory, whether it's mechanisms like sticking and burning, and so on and so forth. No, it's not late. We started like 2 minutes ago. So, as someone says, I'm particularly interested in tokenomics. Yes, we'll be talking about staking on this webinar as well. Now, it's very interesting. We have someone from traditional macro and microeconomics. Yes, a lot of the work that I've done has actually been inspired by more traditional, let's say, traditional economics, and trying to move this over to tokenomics. So, in terms of tokenomics, you know, you might hear conflicting things. That on one hand, A token, a Web3 token, can be the best marketing and fundraising instrument that has ever been created. And we've seen many projects that have experienced a ridiculous amount of success, and they raised a ridiculous amounts of money, like in the tens of millions or more, by issuing a token. At the same time, we've seen that a token is often a way to kill a project if it's not executed in the right manner. Okay, so it's very easy for a project to fail if tokenomics is really not sound. And in the first part of this webinar, I'm gonna walk you through the evolution of TGEs as well as some models. And that's like a very interesting topic for me as well, because this is probably the one area where things have evolved the most. So in terms of token generation events and the evolution across time, we start off obviously with Bitcoin 2009. I joined this space around 2012-13 when Bitcoin started becoming a bit more well-known. And then tokenomics became a thing around 2017 when Ethereum launched. This would enable anyone to create their own token without having to create a new blockchain. And that was the crazy era of ICOs, for those of you who remember them, where anyone could just launch a token. And by launching a token, you could just find that you could just raise money. You know, it was as simple as that. Then ICOs were banned, and that era was over. They banned on legal grounds because a lot of them were securities. And then we saw TGEs move towards smaller TGEs with a lot of private sales, more complex designs like staking incentives. And this is when Solana and Avalanche also showed up, which Solana now is one of the major blockchains. And finally, we have meme coins and bonding curves, I guess, and airdrops. These are some of the latest evolutions. I wouldn't say, the tokenomics of meme coins are, such an innovation. Meme coins, for the most part, are gambling, but we still see some interesting innovations that even serious projects can learn from. And airdrops, of course, which have become very popular. So during the ICO boom, setting the majority of the tokens for public sale was the standard. And there was no reserves, no incentives for developers, no roadmap. And there was a ridiculous amount of money that was raised, and a lot of that was just based on the fact that blockchains seemed to be incredibly popular, and everyone was like, "Oh, I can invest in this project. It's very easy. I'm just gonna give them some money and so on and so forth, and this might be the next Bitcoin." I know it sounds a bit ridiculous, but that's the way it was. And actually, Hacken itself was guilty of this. And I mean, I wouldn't say guilty. I don't think that a lot of these projects were necessarily knew what they were doing. It's normal in every new area, in any new domain, that you make mistakes before you learn from those mistakes and then you improve, right? So this is what happened with the Hacken token in 2017, which now it evolved into the High token with more sound tokenomics incentive mechanisms. So there were a lot of things missing in that period in 2017, which a lot of you might recognize now as a staple, right? Things like no vesting, as in anyone could just dump tokens. There was a lot of price volatility, no lockup, things which you even find in standard shareholders agreements. And these are like some interesting examples, like EOS founders retain 10% of EOS supply, 31 of ETH's pre-mined supply moved to exchanges in the first 3 years. And this is what eventually led to the crash part of that cycle in 2018, 2019. Obviously, crypto is very cyclical, but the tokenomics we witnessed in that era weren't really sustainable. I guess the benefits of that approach, of the ICO approach, was that it was easy to raise a lot of money very fast, and there was a lot of initial distribution and adoption. But obviously, the tokenomics for the most part were not sustainable. They were quite weak. A lot of centralization, huge treasuries, small token reserves, large sell pressure. Plus, there were legal issues, right? So essentially, a lot of this was killed by the SEC. Then in 2021, we saw like the evolution of tokenomics and Web3 space as a whole. This is when the Web3 term first came about, as well as things like DeFi started becoming more popular, leading to the DeFi summer. And we start seeing way more complex tokenomics allocations and distributions. You can see here an example of a typical distribution in that era, which I'd say it's still okay. Essentially, the goal is to make sure that everyone gets a fair share. No single party has unnecessarily large control over the whole supply. No party can dump the tokens just in one go. And back then, things were relatively still easy in terms of fundraising. It was easy to boost the market cap to 20 or 30 million. And yes, 10, 15, 20x or more returns were normal. And obviously the supply was more restricted, as you can see from the examples here, that is Solana and Avalanche. In terms of the pros of this type of supply dynamics is that you had better decentralization and alignment of incentives. The distribution was fairer over time. There was gradual release via faucets. We're going to talk about sinks and faucets later on. And also like the incentives and the supply were kind of like more aligned with what a decentralized project is meant to be, right? At the same time, there were issues like low liquidity and high volatility, concerns around dilution. The cliffs were also, I mean, that's interesting because when a cliff, the event takes place and someone can sell their tokens, there's still the risk of dumping the tokens and the project experiencing sales pressure. Obviously, there was in terms of staking and vesting models, we saw a bit of overcorrection in the sense that we saw models that were way too complicated to work with, especially in DeFi. And project growth obviously should align with rewards and token emissions, which I don't think most projects were aware of this. Yeah. And I think Axie Infinity is a very good example of where things went wrong. A very popular Web3 game. A lot of users, I guess it's actually a fun game to play. But its reward mechanism was actually very faulty, which eventually led to issues with the token price due to an oversupply of tokens. And again, that was a case of not really most of the community as well as teams not understanding the links between project growth, user growth, as well as reward and supply. So 2021 brought more disciplined supply control and community incentives, but obviously far from ideal. We also saw a lot of crazy things in the DeFi market and how some protocols were designed. And now we're in the era of meme coins, I guess. I don't want to say we're in the era of meme coins and suggest that the only thing we're seeing is meme coins, but no one can deny the fact that meme coins in this cycle have been incredibly popular. Not everyone predicted this, not everyone expected this, but it's interesting to see some of the tokenomics in terms of the allocation. So they try to, a lot of meme coins, I mean, some of them, because a lot of them are very centralized, they try to go for a fair launch with a high percentage for a public sale, an initial liquidity pool, and a significant amount in marketing. And another interesting mechanism that is often used, I mean, not only in meme coins, but it can be used in different, I mean, I've used it in my career as well for some designs, is bonding curves. And this it's essentially a mechanism where you define a function that correlates, let's say, the price and the supply with the intention to avoid the market crash. Okay, so essentially it's a way to improve upon free market dynamics until a project reaches maturity. So there are many cases where founders then put their funds into LPs and they just cashed out with the money, right? Whereas the goal was to actually deposit this cash in a liquidity pool and support the project. And this made the community lose faith in public releases. And bonding curve is a way to adjust for this because you're not waiting for someone to deposit their tokens in a liquidity pool, but instead, depending on how many tokens are in circulation, the price is automatically calibrated. So that's I guess a notable mention here, not in terms of tokenomics, but in terms of, let's say, memecoins is Pump Fund, which is completely insane if you ask me. I don't know how long this can last for, where we're seeing a huge influx of new meme coins launching all the time with no real utility, including some ones which seem to be a bit, let's say, dodgy in terms of adult content and things that probably should be regulated, which I think now Pump.Fun is trying to take down. So meme coins, I'd say they're an interesting concept, and we show a lot of tokenomics and let's say a lot of interesting stuff in terms of tokenomics. But overall, the verdict is that probably the impact on the community has been negative, in the sense that it creates a flipping or gambling mindset for investors and users. And for many years, everyone's been saying we need tokens with utility. We need tokens where you need to use them to do something, not just use them for the sake of using them. And meme coins are definitely not that it, right? And there's really no incentive to hold a token in the long term or use it other than just pump and dump it. And it has become a casino-style game. But regardless, we've seen some really cool stuff, at least in terms of marketing and things like that. However, I wouldn't really bet on this kind of trend to continue forever, simply because I feel that in order for this to continue forever, you need a very large percentage of the users in Web3 to just keep on playing in what is now has become an extremely saturated space, okay, with no real incentive to play this game unless you're gambling and you hope that you're going to become rich, right? So I definitely see this as a market that I don't think it's going to grow, right? So at least me personally, I'm not really a believer in meme coins, but I'm a believer in blockchain and Web3. Then another mechanism that has been getting more attention in the last few years is airdrops. So an airdrop is when just a project gives away tokens for free. Quite often, the user that receives the token might have to make certain actions, like post on Twitter about the project and say, hey, I really like this project, and so on and so forth. And the strengths are that this can work in every cycle, bull or bear. And the goal is network growth, not cash, right? So essentially, the goal is to build up the community. And this is really the best economics for mature, innovative, and solid products. In terms of considerations, it's a kind of, let's say, expensive, because you already need to do work without getting paid for it, right? So it's and the TG is no longer a treasury building event, since you've already given away some tokens, and you need budget for marketing, customer support, infrastructure. So it's kind of like a way to bootstrap community growth, right? And then you also have some issues like Sybil attacks, like a user can create 10 different accounts and get a lot of tokens by pretending to be 10 different users. And I guess it brings back a flight to fundamentals, in the sense that in order for a user to be incentivized to take certain actions, against post about the project on X, in order to get the tokens, they need to the project needs to have real utility. But the failure rates in biggest airdrops is the lowest among all type of tokenomics approaches, right, for launching a project. So like Hyperliquid, it seems to be the most notable launch ever. It's not a project I've studied closely, so I can't comment on the utility of the project, but everyone's been saying that this is one of the best TGEs like ever. Then Uniswap is obviously another very successful project that followed this approach, as well as Layer 2, Arbitrum, and Optimism, which are also quite a big deal. There have been some fails, that is Stellar, but it was the early days. So Stellar should have done a traditional ICO maybe back then, as well as ApeCoin. But ApeCoin was based on those ape NFTs that were all the rage during the NFT boom in the previous cycle. And then after NFTs stopped being a fashion, they found themselves with any real utility. The price crashed, and they just try to capitalize on ape through the ape coin and things like that, and it didn't go too far. So I wouldn't say there are some fails, but not necessarily representative examples. So in terms of the supply dynamics, this is and the market impact. This is a summary slide which summarizes before and before and after the key evolution and the long-term sustainability from each era. In terms of the 2017 ICO era, the large initial token dumps led to quick price spikes and then sell-offs. So it's quite interesting if you see some charts from that era. You might see some projects that raised ridiculous amount of money. I know a project that raised 100 million. Since then, it's just flatlined, which is crazy. Like they built a treasury and that's it. The money's just sitting there. And many projects failed due to not only due to poor tokenomics. I think that another problem is that some projects were just genuinely not good, and they just raised a lot of money because ICOs were popular back then, and that's just it. Yeah. Then in the DeFi era, we saw limited initial supply create supply squeezes, which allowed projects to surge the price. Axie Infinity's token is a good example. However, with token unlocks, as well as sometimes unnecessary rewards and things like play to earn and things like that, we saw crashes in the price. So I'd say this is when I felt in that era that we saw tokenomics involving in a level of complexity that we hadn't seen before. And this led to some extent to more sustainable tokenomics, but again, and some mechanisms like vesting, staking rewards can become a staple. But quite often this complexity hid other types of risks, which we're still in the process of addressing. Because when a system is very complex, it's often more difficult to audit. And it feels like the meme coin era is somehow, let's say, a middle ground between the ICOs and the DeFi era, because the price is driven by virality over fundamentals, and things can become kind of a casino, is in the sense that with meme coins, no one's even pretending there's some utility, but at the same time, they don't pretend that they have some kind of fundraising mechanism which is flawless or anything of that sort, right? But again, as I mentioned, I think this is an era that's not going to last forever. In terms of adoption and utility across eras, in the ICO era, we saw fast speculative adoption. I remember a lot of people saying, oh, this is going to be the next Bitcoin, and that's going to be the next Bitcoin. I know obviously the main winner from that era was Ethereum, which was the project that allowed everyone else to build their ideas upon it. And in terms of decentralization, we saw initial distribution, but a lot of whales were formed in that era, which are still manipulating the market. Then in the DeFi era, we saw tokens being integrated into functional ecosystems and incentivizing organic adoption. And we saw broad decentralization over time, but early heavy VC and team ownership, right? So this is when we saw more crypto VCs also bursting onto the scene. And in the current era, the meme coin era, we see adoption driven by hype and social rather than utility. And this can often create some, super cycle called BS, as the slide says. I guess the benefits of that era is there's some more grassroots distribution, the better distribution with things like airdrops, which are not regulated, like handing away security or anything. But obviously, whales are still strong in certain parts of this game. So what we learned from TG mistakes is that scarcity can push value up if demand holds or rises, which is normal. That's basic demand and supply economics. Projects can control the supply through different mechanisms like vesting, staking locks, and burns, which create artificial scarcity. The question always being, how can you match these mechanisms with utility? So it's not just scarcity for the sake of scarcity. And the poor supply control can devalue a token over time. Short-term, hype and demand cycles dominate supply mechanics. And then long-term, a controlled supply erodes price unless matched by sustained demand growth. And so best practices for airdrops is to target active users. As I mentioned, there are platforms like Zilli where you can track whether a user is going through quests, as they call them, like a post on X and Telegram, and then you give them tokens, like a collect point, and then you give them tokens. And you need to communicate and explain what is going on, how the whole process works, provide clear utility, and obviously you still need to be careful with oversupply. So you want to provide tokens, but these tokens still need to have value at some point, right? Which means that you can just provide free tokens and expect everything to just magically work. In terms of sinks and faucets, which is our next subject, this essentially talks about ways to either supply tokens to the market or remove them from the market, right? So in general, when you reduce the supply of something, and if demand stays the same, the price increases. So you kind of want to avoid the situation where you just supply, and you can just, there's no way to stop this, right? So locking is one way to do this, and you also need to create incentives which will prevent users and investors from selling. The strongest incentive is always utility, which that's not always the case, however, for all users, right? So you still need to have some financial incentives for the users to, or like some other mechanisms to prevent them from selling. So a faucet, as I mentioned, is anything that adds tokens to circulation. And here are some examples of faucets, like liquidity mining programs, block rewards, like with Bitcoin, airdrops, yield farming, and play to earn. This is a model that didn't work out too well because there was an oversupply of rewards, not being matched against burns and things like that. I mean, it can still work if someone knows how to make it work, but a lot of projects just didn't implement it the right way. And then anything that removes tokens from circulation is a sink, like staking burns, LP lockups, utility memberships, governance botting. All these are sinks. And quite often it's as simple as just charging a fee and saying, look, I'm just going to burn every token, for example, that's used to pay the fee. But still, for many projects, just ignore this. So high inflation models, they lean heavily on the faucet side. And Axie Infinity, again, is a very good example of this. And Olympus DAO is another one. So the way it worked with these tokens is while the market was strong, they would issue a lot of rewards, and this made more users join the race, and they bought more tokens, and the user base expanded very fast. And this created a self-fulfilling prophecy, but it's not sustainable, right? So in all of these projects then became crashing down soon after, like once the bull run ended, right? And they ran out of a user base that would keep putting money in these things. More projects, like more serious projects, they have sinks, like Ethereum, BNB, or Curve. But obviously, these are not appreciated as much during a bull run. They're more appreciated in the long run, after you see that, yes, this project has still survived. And now let's move on to staking and burning, which in terms of tokenomics, these are essentially a couple more mechanisms which enable a token to maintain or increase its value by reducing the supply. So I think the Terra Luna system is probably the most notable failure in this space. It was an algorithmic stablecoin with two tokens. UST was a stablecoin. Luna was the let's say the utility token, and it was supposed to be a sink at the faucet. It didn't work well, partly due to hyperinflating Luna, partly because of the scandal that happened with FTX and Anchor Protocol and a lot of stuff. But in any case, there was a lot of mismanagement, right? So essentially, I've studied a lot of stable coins. So if you Google my name and stable coins, you're going to find a lot of research in this area. And in any case, I think the only solution for Terra Luna when the crash happened would have been to use their treasury to just start buying back their own token, really. And this is a good example of when having the wrong faucet and sink mechanisms can just destroy a project. Staking is another way to reduce, let's say, the supply, not the supply of tokens, or the circulating supply of tokens, in order to ensure that the price can be maintained or increase. And the way it works is very simple, right? So you as the user, you're like, I'm just gonna stake some tokens. That is, I'm taking them out of circulation and expect to get some reward of some kind, And obviously you have to be very careful here, because if someone just takes their tokens and that they get more rewards in the same token, then you're still inflating in the long run, right? So that's very tricky. You need to really make the numbers work to know what you're doing if this is going to work in the long run. This has worked as a mechanism, as a very successful mechanism in the last few years. There are protocols like ETH where staking is used as part of the core protocol, like actually it's a consensus algorithm. But that's not always the case, right? And there's also the concept of liquid staking, where you can stake tokens and still use them. I'm not a huge fan of liquid staking because I can see the allure of it in terms of yield and the financial incentive. However, if you look into the mathematics behind it, you're effectively opening what is an over-leveraged position, okay? I mean, I can explain why. Probably I don't have time now to talk about this, maybe at the end of the presentation. But in order for liquid staking platforms to survive in the long run, they need to be very, 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 very careful with how they handle the circulation and the rewards and things like that. It's essentially like creating it is a form of a derivative, right? It's a form of a derivative dressed up in Web3 jargon to make it look like it's not a derivative and like it's completely safe. So yes, I'd be a bit cautious there, to be honest with you. I hope you won't see liquid staking causing any big issues on the main ETH supply. So yes, and this is what I was mentioning earlier, that unsustainable high APY models have proven dangerous. That is, like Olympus DAO, for example, had a model where it's like, oh, you buy the tokens and then you stake them, so you remove them circulation, and then you're gonna get rewards in our token. But they would time the rewards in a way that it would work in the long run, and then at least for a while, and then it collapsed, right? So it's a bit crazy what these guys did. This project's still around, but it's a ghost of its former self. And we've seen similar tactics with many DeFi projects where high emissions just kills their token. That being said, again, staking can be a very good mechanism if you know what you're doing. Ethereum is probably the prime example of staking mechanisms that are actually used for something. It's the same with Solana. And even Cardano. Cardano is a project that the technology used to be very exciting. Now it's receiving a lot of criticism. But again, these are some cases where staking actually is quite useful. And really, I'd say the risks behind staking are you have to avoid high rewards. To be honest with you, you don't even need to provide rewards, right? You could even say, look, if you stake, then you get some other benefit in the system, like I don't know, voting rights or discounts, or it depends on what it is that you're trying to do, you know. But I don't believe that issuing more tokens should be the default position. Just because you remove tokens from circulation doesn't mean you should get 10% rewards in those tokens back. You know, it's a bit crazy. And bears and barebacks should take place from the profits and not from the treasury, right? So you have to be very careful. The treasury is there for a rainy day and not just to be used for trading. So modern tokenomics favor small faucets and multiple strong sinks to drive demand and control supply, right? And what is key here is the use of the plural. That is, we want multiple faucets and sinks. We don't want only one, because having multiple mechanisms is safer. Now let's move on to liquidity. Liquidity is the ability to trade tokens without major price changes. And liquidity is supported by liquidity pools. So you can have liquidity pools in DeFi, in places like Uniswap and Curve. And the way it works is they have pricing formulas. Now this is the basic Uniswap formula. In the latest version, this has been updated in all kinds of ways to make it more efficient. And essentially, the benefit of high liquidity is that you can have large trades with minimal price impact. So in terms of the incentive for someone to provide liquidity to a liquidity pool is that they earn fees, and the LP tokens can be staked for additional rewards. And that's obviously where this is interesting, is because it's a decentralized way to exchange tokens, and a lot of liquidity enables price stability over the order books. So in terms of liquidity provision, in 2017-18, we had low exchange liquidity and poor price discovery. And then in the area of DeFi, we saw a lot of liquidity going into the system, and also the pool size is getting bigger. Then we moved on to the curve wars, still part of the whole DeFi ecosystem, where protocols bribed for curve finance liquidity to deepen stablecoin pools, and they recognized that they need deep liquidity in order for the token to be usable. Then Uniswap, as I mentioned, to the latest version, they've done a lot of innovation to enable liquidity across different price ranges, and this enables greater capital efficiency. And now we're at version 4, where there's active liquidity management and automated strategies. So like version 4 is, very long way from the days where a liquidity pool was just a simple formula. So there also been liquidity fails, that is tokens that skyrocketed in market cap but had scant liquidity. For example, the Squid Game token, it hit a crazy valuation, but then no one could sell the tokens, which is kind of useless, really. And this is also seen in memecoins and low cap ICO tokens. And it's something that, it's normal. It can happen in the stock market. If you ever heard the term penny stocks, it's essentially stocks that suffer from liquidity fails. That is, you can't find buyers or sellers, usually sellers. And that's why this is something that the project should take very, very seriously, because good liquidity programs result in deep, stable pools that can handle large trades with minimal impact. Curve's 3 pool, give me a second, became so deep that multi-million-dollar swaps moved the price by only a few basis points, which obviously instills confidence in those stable coins. And projects that lock in liquidity through incentives like LP incentives, protocol-owned liquidity. Olympus DAO, I think, was the first project to do this. That was a good piece of innovation. They ensure a stable market for their token. And Frax, which is a partially collateralized algorithmic stablecoin, which has survived the Terra Luna problems and all that, exhibits this. So in terms of what is a LP to fully diluted value ratio, if a project's fully diluted value is huge, but pool liquidity is tiny, then prices are unstable. So even if small sales, even small sales can tank the price. So you need to have a decent amount of liquidity, which is going to lead to low slippage and investor confidence. Slippage is essentially the price that you want to buy or sell is the price that you get, right? So high liquidity relative to valuation acts as a buffer against volatility, and low LP FTV ratio can signal an unsustainable price, right? So you have a lot of people that might want to sell, and just the pool is very, very small to support this. So sustainable liquidity provisioning through incentives and LP vesting creates a stable trading environment and healthy price. And let's talk about the launch strategy, reaching the end of this presentation. Eventually, you need to sell your soul to the Web3 devil, but which one? Do you want the centralized exchange, decentralized launchpad, or a fair launch? Unfortunately or fortunately, the era when everyone could just do an ICO and raise a lot of money is over. So now founders of projects, they have to go through a lot more decisions to figure out what's the best strategy. In terms of centralized exchange listing, the benefits are the high liquidity, you get a lot of retail investors, market depth, and credibility. But obviously, the listing fees can be steep. You have to go through compliance, centralized control, and there's the custodial risk of an exchange getting hacked or similar. Decentralized exchange listings can often be a better alternative because you don't need approval. The valuation essentially takes place by the market, the liquidity pools are the traders, and you have full control of what you're doing. Obviously, the con is that you don't have anyone to promote the project for you. You get low liquidity, you might get slippage, bots, high volatility. So essentially, you're taking up more of the work that the centralized exchange would take up for you. And Launchpad deals with pre-screened investors and some liquidity support and maybe marketing, depending on the Launchpad. But sometimes the barrier to entry can be high. You deal with platform fees, dumping risks, whales, and quite often the amounts raised via Launchpad compared to a centralized listing can be smaller simply because you're addressing a smaller pool, even though this can depend. And then you have a fair launch where users can get equal access. You have a stronger community, long-term stability. This is done through airdrops. But obviously, again, that's not trivial. You have less capital, high risk. You need to have a good product. You really have to have good product market fit and marketing. And you need to take over a lot of the expenses that maybe someone else would take for you if you were going through another alternative like a launchpad or a centralized exchange. So in terms of allocations, the do's and the don'ts, the idea behind allocation is really two things, right? You want to avoid you want to avoid any single group of people having a large control over the supply, as well as ensuring that the incentives are aligned. So usually the best types of allocations, they assign a very long vesting schedule to the core team in development to show to the community that the core team is dedicated to the project. Investors have a relatively long vesting period, but shorter than the team. And then you assign most of the rewards to the ecosystem over a long period of time. In terms of unbalanced allocations, that's things like meme coins. We saw this with the Trump meme coin, where the vast majority is controlled by insiders. In terms of communications, you need to make sure that communications and marketing is for informational purposes. You need to comply with relevant standards. You have to be very careful with unconfirmed listings, promisings, return on investment, and you want to avoid being classified as security. So you need to be very careful with what you're saying. And in certain ways, like pump.fun enabled the creation of these meme coins, which obviously it looks like it's gotten it into legal trouble, as I mentioned. Like a launchpad are a way usually to make sure everything's compliant. They might, the part of the service they provide, and I guess this makes things a bit more transparent and clean. KOLs are quite popular now. That is marketing through influencers as well as the community. That's regarding investors, and you might also have to go through KYC, AML, this type of stuff with investors. But you always need to be aware of the jurisdictions and the laws regarding each and every jurisdiction. Again, that's the purpose of this webinar, is not to give you legal advice. We can't give you legal advice, but we can definitely tell you to be aware of jurisdictions and legal issues that might arise. And now we're at the end of this presentation. I'd like everyone to invite everyone to use the QR code on the screen. There is an Excel spreadsheet that's going to help you prepare your token launch strategy. Obviously, as you have realized by now, launching a token involves many interconnected components, some of which we try to cover to the best of our ability in this presentation. And what this spreadsheet is going to help you with is write down some metrics like allocations, vesting schedules, strategic considerations, so on and so forth. And it will essentially be very good preparation for what's going to come next. And what's going to come next is the design of the token economy, the simulation of the token economy, auditing the token economy, in order to ensure that the token economy can actually fulfill its purpose and the token is not going to crash. And this is where we go with the last slide. This is another QR code where if you want a quote on this service that we provide through Hacken, feel free to scan this QR code and to learn more about how we can help you improve your token model and get you ready for launch, or if you've already launched, how to further improve the model and audit it. And again, auditing is one of those things that every project needs to do to increase the faith and the transparency and the reliability of the project, demonstrate to retail and angel investors alike that yes, this is a project that is actually in it for the long run. So, okay, so that was the end of the presentation. I'm going to take a breather and I'm going to see if there are any questions. So let me see. Sure, apologies, I'm going to have the question. So locking a token, I mean, in terms of locking a token, you need to code the smart contracts in a way that the token can be locked. but I think we covered this in the presentation. That essentially it means that you own the tokens, but you can't use them for a specified period of time, let's say 6 months. The goal being that you remove them from circulation and you prevent dumping. Do you think one should activate sinks or faucets along the time in a reactive manner or with a predetermined roadmap? I think most projects try to do it via a predetermined roadmap, and I think most projects are wrong. It's always good to be dynamic and a bit more reactive because the market can be very volatile. So if you can be reactive, this is better. What is the actual advice for those who are in the process of tokenomics ideation? Well, I think that tokenomics ideation it can involve various steps. Is something we help you with. I think the first step has to be what kind of business you want to build. What is the objective behind the business? Yeah, and this is really where you should start from. What is it that you're selling? What is it that generates utility in the project, right? And then design the token around it. In terms of testing tokenomics via tools like CADCAD, yeah, I think it's a good approach. In Hacken, we have our own tool called Token Lab. It's a tool I've personally developed, and I'm posting on now in the comment section for those of you who can find it, who can see the comments. If you can't see the comments, just Google my first and last name and Token Lab, and you're going to find the GitHub. It's an open source project, and we use it for simulations in all of our projects with Hacken. In terms of experience or opinions of staking rewards not being in the underlying token but in shares of revenue, if you do this, you may be classified as a security. It's very, I'm not saying it's a bad idea. It's going to raise a lot of legal issues, repercussions. So you need to be prepared for a lot, to invest a significant amount of money to make this work. So I don't think I'd advise you to do this. What economic strategy to use to increase volume and liquidity? So I guess, well, the main way to really increase volume and liquidity is adoption, right? So that's the first and foremost the reason to increase utility. So this is where there's really not one size fits all. So if you go back to airdrops, for example, you could say that by issuing airdrops, you automatically have the token in circulation, people are using it. But then again, you don't want them to just dump the token, right? So you also want to have buyers on the other side. So this is where you kind of need to think this strategy throughout. First, I'm going to do this, and then I'm going to do that, right? In theory, a centralized exchange listing can solve quite a lot of these problems because especially if we're in a bull run, they might market the coin so much that you just have a lot of users and a lot of traders trading the coin, and this kind of solves the liquidity problem. But again, I think I'm not sure that you just want to think only in terms of hacks. You want to think in terms of the per step strategy. But eventually, you don't want users to want to use the token. And this is what's going to drive volume and liquidity. What about allocation for founders? Yes, that's part of the team allocation. Yeah, up to 20% usually. And again, a lot of this stuff is in terms of perception and how much the founders trust each other. You know what I mean? It's like we saw, for example, this crazy thing that happened with Argentina's president who launched a meme coin. There were a lot of insiders, and it looks like one of them, they weren't the insiders who were meant to sell, and one of them betrayed the rest and just sold the token. And it was a very weird situation, so it kind of depends. An investor might tell you, it would be ideal if there's smaller amount of tokens assigned to the team and you just guys have a vesting schedule of 5 years. Then again, who's going to be motivated to do this, to vest the tokens over 5 years? So you need a balance, essentially. You need a balance. If you have any pre-launch valuation methods, yes, absolutely. So if you Google my name, you're going to find a lot of papers, and a significant part of my research has focused on pre-valuation methods for tokens, essentially trying to figure out, given a set of numbers, what is the expected fair value of a token. So then if you can price this at a multiple, which we see quite often in the bull run, what should be expected and what will be the expected return on the investment. All of this, most of these things I've researched are already in Token Lab, so they can be used in simulation. I have tried the AMM pool equations in the machination models, Monte Carlo analysis, the assumptions. But any model would depend on assumptions, right? But essentially, the assumptions that we use in Token Lab, they evolve around assumptions in terms of the user base and the volume of transactions. The reason we do this is, well, there's a couple of reasons. First of all, this is how the formulas work out based on my research. Secondly, if you have if you create a business, I mean, Web3 aside, if you go to an investor, any reasonable investor, the investor will ask you, what's the size of the total addressable market or the obtainable addressable market? What are your goals for the next 1, 2, 3, 5, 4, 5 years in terms of, you know, the capital allocated versus the return, user-based transactions, etc. So if you can't even provide this, then this means that you haven't really thought your idea through. You're just like gambling with investing your time in an idea and hoping it works, you know? So you kind of need to start from somewhere anyway. What creative alternatives exist to provide sufficient liquidity at the lowest possible cost for the founders, assuring that our token can be traded in the market? So when you say sufficient liquidity at the lowest possible cost, what do you mean? As in ensuring that the allocation to the founders stays high, or that the founders don't have to invest money? Because, you know, there's also like one thing that we didn't touch upon is market makers, as in there's some market makers that they only charge a commission fee. So quite often, if you have a, you know, decent amount of liquidity, then the market makers can trade it and make the magic happen. So that's one thing to keep in mind. Otherwise, yes, I'm not sure what else to advise there, you know, other than the points I raised before. In terms of the post-TG token, what can they do afterwards? Launching wants to fix the token product market. There are a few cases where we've observed this, as in the token had to relaunch, like again, Hacken being one such case with a high token. There have been also with Hacken, we worked with a protocol, I can't name it, but it's a big protocol, was working for a few years, and they redesigned their tokenomics around July. So it can happen. The problem is usually not so much with the tokenomics, because you can always redesign them. It's just more difficult once something is operational. The problem is with rewriting smart contracts and making sure everything works on a blockchain. What about auctions as a way to discover value? I like auctions as a way to discover value. It's just, it feels that auctions were very popular during the ICO boom, and since then they've become less popular. I mean, someone might be able to mention a project that recently used auctions. I can't get any on top of my head, whereas I remember in the ICO era, it was auction this and auction that and Dutch auction and this other type of auction. It was crazy. Yeah, and also feel free to connect with me on LinkedIn. I think a few of you might be watching this on LinkedIn. I'm not entirely sure, but yeah. Any more questions? Yeah, perfect. Glad you liked it. So yeah, as mentioned, make sure to use this QR code to receive your quote, and also and also make sure to connect with me on LinkedIn. Also, a lot of the stuff, you know, that we're doing is just free for the community, like the research and Token Lab. Is there a time, maybe you can expand the paying out part of the revenues makes you a security token? Yeah, so that's actually easy to answer. So security means that you own part of a business, like a share, you know. So if you do this, then this falls under the scope of special regulation. So you can't say, hey, you know, while financial regulation says that, look, there's like shares and stocks and things like that, that oh, I'm just going to use tokens to do the same thing, and you know, won't have to pay certain fees and things like that. So that's why you need to avoid this. Whereas if just everything is in a token, say, oh, I'm dropping a token and you get rewards in a token, and that's just it, and then you have to use my token if you want to access a service, but that's just it, right? Then usually for all intents and purposes, that's not called a security. There's this Dewey test for securities. Again, I'm not a legal expert, but if you look into it, it's easy to see, you know, find some ideas. Like essentially, a lot of the problems in 2017 were around the fact that many projects were trying to use tokens in the same way as a security, really. Then the SEC violently cracked down on a lot of them. A lot of people paid fines and ended up in jail. It was a very bad period. And since then, there's been a lot of acrobatics in tokenomics to come up with designs that try to avoid this issue altogether. If we share the presentation, I believe so. Just make sure to get in touch with Hacken or drop me an email. Yeah, we'll be happy to also share the presentation. Yeah. So perfect. I think, there's only one more question. We have to leave in a minute as well. We're like 3 minutes before closing, but the treasury is like, let's say like a bank account that you're keeping for those situations where you might need to use the money for whatever, could be market making, could be rewards, could be building, could be anything. And it's a good practice just to keep a treasury for those situations. Like I think that Terra Luna had a very good treasury, and if they had used it early on to buy back their token, they wouldn't have crashed, in the way they did. The project would still be around. So this is what the treasury is for. So anyway, thanks everyone. If you have any more questions, please do not hesitate to reach out to us. And thank you for being here with us today. We really appreciate it and hope to be hearing from you soon. Thank you.